Okay, I'm going to show you how to use Excel to do a capital budgeting analysis. And the example that I'm going to use is the Majestic Mulch and Compost Company, which is on page 315 of your text. Now the first thing that I want to do is, as I read through, I want to create basically inputs that I will refer to later in my Excel formulas. And as we go through, we'll talk about what costs to include and what not to include. Okay, as we read through, the first thing I see is a table with each year in unit sales. By the way, this is some sort of power mulching tool, whatever that is. And so the first piece of advice I would give you when you're laying out something like this is to do your years going horizontally from left to right. And the other thing that I would tell you is, even though it says starting in year 1 here, we're going to have a year 0 later on because of the investment. And so what I really want to do is go ahead and start with year 0 and go all the way across. 7, 8. Very good. That's all the project. Okay, so we have unit sales here. And for year 0, of course, it's 0. We can go ahead and type that in. Just remember where we're at. I'm going to underline all this. That'll help us to be able to see that later. There we go. And year 1 sales are 3,000. Year 2 sales are 5,000. Year 3 sales are 6,000. Year 4 sales, 6,500. Year 5 sales, 6,000. Year 6 sales, 5,000. Year 7 sales, 4,000. And year 8 sales, 3,000. So let's go back and check our numbers. This is important because if we get this wrong, the rest of it will be wrong too. So year 1 is 3,000, year 2 is 5,000, year 3 is 6,000, year 4 is 6,500, year 5 is 6,000, year 6 is 5,000, year 7 is 4,000, and year 8 is 3,000. Very good so far. Now I'm going to go ahead and save this thing, and save it here under Spring 2012 Dalian, and we'll call this a mulch example. You always want to save your work, save it early and save often. That way if something bad happens, you'll be able to do something about it later. Okay, now the next thing it tells us is the power mulcher will sell for $120 per unit to start, but when the competition catches up after 3 years, they anticipate the price will drop to $110. Okay, so we're going to put a unit price here. And of course we don't have to worry about it for year 0 because they don't sell anything there. They tell us it'll sell for $120 to start. And then they say after 3 years they anticipate the price will drop to $110. Now that could be interpreted a couple of ways, but if you look at table 10.11, they show that unit price to be $120 all the way through year 3, and then goes down to 110. Oh, not 11, 110. Now, instead of typing 110 over and over again, I can say copy and paste, and we're good to go. I'm going to hit save again, and all I'm doing is hitting Control S. You could also, of course, hit your little disk up here to save. Okay, so far so good. Can we figure out our annual sales figure now as far as revenue? I think we can. And so let's go ahead and do that. Now what would revenues be? Well, it'll be the number of items that you sell times the amount that you receive per item. So basically it'll be the sales times the price. And of course there's 0 revenue in year 0. Now check this out. I could type this in over and over again, or I could say copy and do what I did earlier up here with 110, but there's an easier way. All I have to do is grab this lower right hand corner. Notice how the plus sign that's white turns into a black one, that's when I know it would be okay to hit my left mouse button and drag that all the way over. And that puts a formula in each one of these cells that takes the cells, two cells above it, and multiplies them together. Now check this out. I could also click up here on my formula bar, and it'll show J4 in blue and J5 in green. And that's exactly what it does here. So you can see what cells go into a formula simply by clicking up here in the formula bar. Okay, so far so good. They also give us some ideas about net working capital. Now we're going to have to figure that out later, what the changes in net working capital are. Right now, what I'm going to do, I'm going to go ahead and copy this year 0 through 8 and put it down here, and we'll set up our net working capital separately. So net working capital. By the way, net working capital is merely current assets minus current liabilities. What kind of things go into current assets? Well, that would be your cash, inventory, and accounts receivable. And what kind of things go into accounts or into current liabilities? Well, the big one we work with is accounts payable. And so what we're really looking at here is cash plus inventory plus accounts receivable minus accounts payable. That's called net working capital. And anytime you start a project, you have to have net working capital to get things moving. And so just like if you were going to move into a new apartment, you would have to have some cash to get things set up. And what they do is they tell us that the net working capital will be $20,000 to start with, and that after that it will be 15% of the sales for the year. And so what I'm going to do is say equal to 0.15 times, and I'm going to select, when they say sales they mean revenues, multiply by revenues. And so we see that we can drag that all the way over, and now we have our net working capital all the way to the end. Okay, now something that they're not telling us here is that at the end, net working capital has to go back to 0. And so there will be basically at the end of year 8, we're going to take that $49,500 back. But we'll deal with that here in a second. So the next thing we should probably do is figure out what is the change in net working capital. What we're shooting for here, our goal at the end, is to have cash flow from assets. And the way we figure cash flow from assets is to combine operating cash flow and subtract the change in net working capital and subtract the net capital spending. And it's those cash flows from assets that we're going to discount at the required rate of return to find out what the net present value for our project is. So right now, let's go ahead and figure out what is the change in net working capital. And the symbol that we associate with change is delta, which is a Greek letter. It's this triangle. So I'm going to go ahead and insert that there. Say close and put in NWC. Now, for some reason, Excel always does that. Why does it want to change fonts? I have no idea. But we're just going to reselect 11. There we go. Now, the change in net working capital for the first period is just the initial amount because we're going from 0 up to 20,000. Now, we need to figure out what is the change for each year. So from going from year 0 to year 1, we increase by $34,000. Well, how am I going to make that work with a formula? I'm going to say equal to, I'm going to select the new amount of net working capital, and I'm going to subtract the old amount. And there we go. And then I'm going to do the same thing I did earlier. I'm just going to drag that on over. And so what we see is net working capital jumps 20,000 at year 0, 34,000 at year 1, 36,000 year 2, 18,000 year 3, and then it starts to go down. Now here's the way I want you to think of net working capital. If the balance of net working capital goes up, then that's actually cash out of your pocket. Net working capital, think of it like a savings account. If you take money out of your pocket and put it into your savings account, the balance on your savings account goes up, but the balance on your pocket or cash goes down. If, on the other hand, you withdraw money from your savings account, the balance on your savings account goes down, but the balance in your pocket goes up. And so think of net working capital as a savings account. Now we need to figure out a cash flow. Let's call it I'm going to copy this, change in net working capital, and I'm just going to throw a CF for cash flow on here. And it's basically just going to be equal to minus this cell right here. And I'm going to drag that over. Why? Remember we said if you're increasing the balance of net working capital, that's money out of your pocket. And if you're decreasing the balance of net working capital, that's money into your pocket. Now there's one little problem left here though. This last year, there is also the need at the end to get rid of that final $49,500. Now why do we say that net working capital goes back to zero at the end of the project? Well, it was actually zero before we started. We do this project, and at the end we're going to use all the raw materials that are in inventory to make products. We're going to sell those products. We're going to collect the accounts receivable. We're going to pay off the accounts payable, and that means the end of any net working capital required for the project. And so down here at the end, in addition to this minus J12, we're going to have minus the remaining amount. And so that money's all going to drain out there at the very end. That didn't quite work. Minus, okay, that's why. So this is money back into our pocket. This needs to be a plus. And so at the end, we're going to get this $16,500 decrease in net working capital plus the $49,500 back, gives us a total cash flow there, positive cash flow of $66,000 at the end, which not coincidentally is exactly the same as the amount of net working capital at the end of year 7. Okay, so we've got those cash flows down. Let's go back and see what else we can do. They tell us that our variable costs, we're told per unit that there are, let's see, what's the variable cost? $60. So variable cost, let's say cost per unit. In year 0, we don't worry about it. But in every other year, going across here, it's 60. Let's see if this will work. There we go, 60 all the way across. And so then we also have a fixed cost per year. Now that fixed cost does not start in year 0. It starts in year 1. And they tell us that the fixed cost is, where is that at? $25,000 per year. $25,000. And I'll just drag that all the way across. Now, here I'm going to insert some cells here because we're running out of room. So what I'm going to do is I'm just going to highlight these rows and I'm going to say insert. And that's just going to knock them down the page a bit. Now I need to figure out what my total costs per year are. And that's going to be a combination of my variable costs and my fixed costs. And so what we want to do is say it's equal to our fixed cost per year plus, and you don't have to put this parentheses in here, but it might make you feel more comfortable. I'm going to put a parenthesis in there. I'm going to take the number of units that we're selling and multiply that by the cost per unit. And that gives us a total cost number. And so for year one, that is $205,000. Now in your book they do it slightly different. This is in table 10.11. They leave them separate, but for our case, for our purposes, we're going to do total cost. So we're just adding together their variable costs and fixed cost lines, and we get exactly the same numbers. Okay, now we have all of our operating stuff down. We need to consider depreciation. Now depreciation in this case is governed by something called MACRs or makers, depending on who you talk to, but it stands for Modified Accelerated Cost Recovery System. And in our book on table 10.10 in page 316, you can see about MACRs. And we have, this is 7 years MACR, there are 8 percentages. It always works that way. If you have 5 years MACRs, you'll have 6 percentages. They'll all add to 100%, but that's the way it always works. And you multiply those percentages by the initial investment to find out your annual amount of depreciation. So let's insert some lines up here. Insert. And I'll just copy this because we're going to do years again. And just paste. And so I'm going to put MACRS right here. And for year 0, there's no depreciation. In year 1, our book says 0.1429, 0.2449 for year 2, 0.1749 for year 3, 0.1249 for year 4, 0.0893 for year 5, also for year 6, and also for year 7. And then finally in year 8 we have 0.0445. Now just to make sure that I type those numbers in right, I'm going to say equal sum. That's just going to add all these together, select them all, close that, and it adds to 1. So we did that right, or at least we screwed up in such a way that it still added to 1. Okay, next we're going to do depreciation. This is an annual amount of depreciation. Now, in order to be able to calculate this, we need to have our initial investment amount. And that's an input that we should have up here, because what if that for some reason changed? By the way, in all the projects that I've ever done in the real world in industry, that initial investment amount always changes and hardly ever goes down. You always have things that you didn't think about to begin with that you need to worry about later on. So we'll go ahead and put that in. They tell us it's 800,000, and they tell us that our market value at the end of that asset, that's in year 8, they tell us that is equal to 20% of the initial investment. Actually, they don't say 20%, they just say $160,000. So we're just going to enter $160,000 right there. Okay, now to figure depreciation, all I have to do is say equal to, click on the percentage for the makers, I'm going to multiply by that initial investment. Now when I pull that across, if I don't do something special right now, the next one will be multiplying by C1, and the one after that by D1, and so forth. So what I want to do is fix that cell reference for the initial investment. So I'm going to hit F4 on my keyboard, and it puts those dollar signs in. And what that means is, no matter where I copy that or paste it, it will always say B1 there. Now that C9 is going to change, but the B1 will not. I'm going to demonstrate now. I'll just drag it on over, and if I click here, notice that it still says B1. It's still multiplying by that initial investment. Okay, now we're going to figure out the book value for the investment. Now, the book value always starts out at the initial investment at time 0. And then it goes down every year by the amount of depreciation. So all I have to do is say equal to the former book value minus the present year's depreciation. And I'm going to drag this all the way over. Now notice that the book value at the end is 0. That's not always the case, but it works out here because the length of our project is the same as the number of years of Macker's decimals that we have. If we had been doing a 5-year project on with a piece of machinery that was declared by the government to be a 7-year Macker's piece of machinery, we would not be able to depreciate the entire book value of the machine. Now let's discuss this very shortly. The Macker's number of years may or may not have anything to do with how long the machine actually lasts. For instance, when I worked in industry, I got my first supervisory role in 1997, and the machines that I had were all made around 1974. And so they had all been completely depreciated out years ago under, say, 7-year Mackers. But they were still producing good parts that I was selling for on the average of $12 million per year, my total output. And so what we see here is that the Macker's percentages and the book value probably have little or nothing to do with the actual value of the piece of machinery. It's just merely required by the United States government for calculating depreciation, because depreciation is used in determining our taxes. And so that's why we care about these things. Okay, so now what I'm going to do is I will put in depreciation here, and I'm just going to copy what happened above. I'm just going to link to that. And the idea here is I want to link to as many things as I can. So if I change something up here, for instance, what if I change the initial investment right now to $900,000? Everything changes below that was related to that. So that's what you want to do with your spreadsheet. That way, if something changes, you only have to change one number. You don't have to change lots and lots of things. Okay, I think we are finally ready to calculate our earnings before interest and taxes. And what would that be? Well, we're just going to take our revenues minus our total costs minus our depreciation, and we'll call that EBIT. And we can see that we got exactly the same number as the book did in table 10.11. Now I'm just going to drag that on over. And in fact, I can take it one back if you want. I'll just copy it, paste it there, because it's 0 there. Why? We didn't sell anything, we didn't have any variable costs, and so forth. Okay, now we need to be able to figure our taxes. And to do that, we need to have our corporate tax rate, which I'm going to put up here. And they tell us that our corporate tax rate is 34%. So I'm going to put in 0.34. And if you like, you can format that as a decimal or as a percentage. But now what I'm going to do is I will figure my taxes as 34% of the earnings before interest and taxes. So I'm just going to take that multiplied by, I'm going to select the tax rate. Now once again, I want to fix that cell reference. So I'm going to hit F4, hit enter, and drag that on over. So now we have our taxes, and our taxes come out the same as the book, so we're good so far. Now finally, to figure out my net income, all I have to do is take EBIT and subtract my taxes. I'm going to drag that over, and now I have net income all the way across. Now, your book doesn't do this, but I'm going to insert one more line here, and we're going to go ahead and figure out operating cash flow, or OCF. And all I have to do to calculate OCF is to take my net income and add back depreciation. Why are we adding back depreciation? Remember, depreciation isn't a real cash flow. It doesn't represent an outflow of cash. The only reason we care at all about operating or about depreciation is because we need it to figure our taxes. Well, we've already done that, and now we're adding it back. And so this is one of the three things we will need to find cash flow from assets, and this one right here is as well. And I think now finally we need to figure the last one, which is our net capital spending. So I'm going to take year 0 through 8 here, copy it one more time. The reason I do this is just to make it easy to see. And we know that there is, let's see, there's only really one machine here that we're concerned about. Sometimes you'll have more than one, but here we're only concerned about one. And so we'll say capital spending. Actually, net capital spending. Or NCS. And in the first year, we are going to spend the amount of our initial investment. But then nothing happens for all these years. But at the end, we are going to get back the after-tax salvage value of that machine. Now, why do we say after-tax salvage value? Well, if we sell that machine for something other than the value that we have on the books, that means we have either over or under depreciated the assets, which means we've either over or underpaid our taxes. In this case, we've over depreciated the asset. We took it down to $160,000, or we took it down to 0, and then we're going to sell it for $160,000. So we over depreciated that asset by $160,000. So we're going to have a tax consequence for that. Now, how do we account for that? After-tax salvage value is simply equal to the market value of the asset minus, open parenthesis, the market value of the asset minus the book value of the asset, close parenthesis, multiplied by the tax rate. And since this is going to be money coming back toward us, I'm going to start out by putting a negative. I'm going to open the parentheses, and we said the first thing here was the market value. And then I'm going to subtract, open parentheses, the market value minus the book value at the end, year 8, close parentheses, multiplied by the tax rate, and I'm going to close the parentheses. By the way, when you do a formula, always make sure that you have the same number of open parentheses and close parentheses. Otherwise, it won't work. And I'm going to hit enter. And it shows us getting $105,600 back at the end. Now, I'm going to make this into what NCS cash flow, because when you spend money, that's actually cash flowing out from you. So it's just going to be just like above for the net working capital cash flow. I'm going to do a negative there, and I'm going to select that 800,000, and I'm going to drag this thing all the way across. And it makes perfect sense that this is positive at the end, because that's money we're getting back. That's money back into our pocket. Like when you sell an old car. You may buy a new car for $10,000 and at the end of its life sell it for $2,000. That $10,000 is cash flow out of your pocket. The $2,000 is cash flow back in. And I'm going to make this bold because it's the final piece of the puzzle. Now we can figure out our cash flow from assets. Cash flow from assets. You may hear me call this CFFA. And all it is adding all these three things together. So I'm going to say B24 plus B29 plus B33 and hit enter. And I'm going to drag that on over. Okay. Now we finally have the numbers that we're going to be looking at for our net present value examination. So now how does NPV work here? Well, first of all, we need to know what the required rate of return for the project is, or the discount rate. And they tell us it is 15%. So I'm going to type in 0.15 and then I'm going to format that as a percentage. Oh, it didn't work. Percentage. There we go. Okay, now NPV in Excel is messed up. There's a formula we can use, but it doesn't work the way it should. I'm going to show you how to make it work though. I'm going to start out by saying equal, and I'm going to type NPV. That gets our NPV function going. And the first thing they ask for is the rate. That's this discount rate. And then we need to put in a comma, and then we need to put in the cash flow starting at year 1. If you start at year 0, you will get the wrong answer. And I'm going to add then the cash flow from year 0. Now, why don't I have to find the present value of it? Because it's already at time 0. Now, that came out as a percentage, and I don't know why. But there we go. I just reformatted as dollars. And I'm getting $65,487.70. Your book says $65,488. Now, this is what we were looking for. This is what this entire effort was all about. And that was determining NPV. Why do we determine NPV? Because if it's positive, that means we should accept the project because it creates wealth for our shareholders. If it's negative, we should reject the project because it is destroying shareholder wealth. And remember, the goal of financial management is to increase the wealth of our current shareholders.